The screens are flashing red. The algorithms are misfiring. The price of silver just printed $90 for the first time in human history. And somewhere in a glass tower in Manhattan, a risk manager is staring at a number that should not exist. He's watching his bank die in real time. This is not a rally. This is not a bull market. This is a loss of control. The institutions that have managed the silver market for 50 years have lost their grip. The levers they pull are no longer connected to anything. The buttons they press do nothing. They are sitting in a cockpit where every instrument has failed, and the ground is coming up fast. I have been tracking this situation for weeks. I have been warning you that the pressure was building. I told you about the emergency meetings. I told you about the margin calls. I told you about the vaults running dry, but even I did not expect it to happen this fast. Silver did not walk to $90. It teleported. In the last 72 hours, we have witnessed the most violent short squeeze in the history of commodity markets. More violent than nickel in 2022. More violent than cotton in 2008. More violent than the Hunt brothers in 1980. Because this time, the shorts have no exit. Let me explain what just happened. The banks have been selling paper silver for decades. They sell contracts that promise delivery of metal that does not exist. This works as long as nobody asks for the metal. But somebody asked. Actually, everybody asked. All at once. The industrial buyers asked. Samsung needs silver for semiconductors. They want delivery. Tesla needs silver for electric vehicles. They want delivery. The solar industry needs silver for panels. They want delivery. And when they looked at the warehouse receipts, they found something terrifying. The silver was not there. The registered inventory at the COMEX has collapsed to levels not seen since 1993. There are more claims on silver than there is silver to claim. This is not a conspiracy theory. This is basic math, and when the math breaks, the price explodes. That is what we are watching. The price is not rising because of speculation. It is rising because of physics. There's not enough metal to satisfy the contracts. So the price must rise until someone surrenders. Someone must sell their claim. Someone must walk away. And right now, nobody's walking away. The banks tried everything this weekend. They raised margins. They threatened position limits. They called the regulators. They begged for intervention. But the market did not care. The market smelled blood. And when a market smells blood, it becomes a predator. They lost control. These three words will define the next decade of financial history. The era of managed markets is ending. The era of price discovery is beginning. And the first asset to be repriced is silver. Why silver? Why not gold? Why not copper? Because silver is the most manipulated market on the planet. For years, the ratio of paper claims to physical metal has been obscene. Some estimates suggest there are 300 ounces of paper silver for every ounce of real metal. That works in the dark. It does not work in the light. And someone just turned on the lights. The industrial demand is the match. The investment demand is the gasoline. And the short position of the banks is the dynamite. All three have combined at the same moment. This is not bad luck for the banks. This is karma. They suppressed the price for so long that they created the shortage. They made silver so cheap that the miners stopped exploring. They made silver so cheap that the recyclers stopped recycling. They made silver so cheap that the users did not bother to conserve. And now there is none left. The price of $90 is not the ceiling. It is the floor of the new reality. I know this sounds extreme. I know you have been trained to expect pullbacks. You have been trained to expect the banks to win. But this time is different. This time, the banks are on the wrong side of a physical market. They cannot print silver. They cannot hack silver. They cannot legislate silver into existence. They can only buy it. And buying it makes the price go higher. This is the doom loop I warned you about. The more they try to cover, the higher the price goes. The higher the price goes, the more losses they take. The more losses they take, the more they have to cover. It feeds on itself. It is a financial black hole. And we are watching it consume the shorts in real time. In this emergency broadcast, I'm going to break down exactly what happened this weekend. I'm going to show you the mechanics of how the banks lost control. I am going to explain why $90 is just the beginning. I'm going to reveal the next targets based on the mathematics of the squeeze. And I am going to give you the action plan to protect and grow your wealth in the most volatile market of our lifetime. The game has changed. The rules have changed. The winners and losers have changed. If you are holding physical silver, you are about to become wealthy. If you are short silver, you are about to become a cautionary tale. They thought they could control the market forever. They thought paper would always beat metal. They thought the public would never wake up. They were wrong. This is the story of how they lost control. And they are never getting it back. To understand why $90 silver is not the top, you need to understand the architecture of the fraud that created this moment. You need to understand how the banks built a paper castle on a foundation of sand. And you need to understand why that castle is now collapsing. The silver market operates on two levels. There's the paper market and there's the physical market. The paper market is where contracts trade. These are promises to deliver silver at a future date. The physical market is where actual metal changes hands. For decades, the paper market has set the price. But the paper market is a fiction. Here's how it works. A bank sells a silver futures contract. This contract promises to deliver 5,000 ounces of silver in 3 months. The bank does not have 5,000 ounces. It does not plan to get 5,000 ounces. It is betting that the buyer will sell the contract before delivery. And usually, the buyer does. The contract is rolled over, the delivery never happens, the bank collects the premium. This works when everyone is playing the paper game. But what happens when someone actually wants the metal? What happens when Samsung says, we need 10 million ounces delivered to our factory in South Korea? The bank has a problem. It sold something it does not have. Usually, the bank can source the metal from the COMEX warehouses, but the warehouses are empty. The registered inventory has dropped below 30 million ounces. That sounds like a lot until you realize that global industrial demand is 500 million ounces per year. The COMEX has 3 weeks of supply. And the demand is not slowing down. This is the first pillar of the squeeze, physical scarcity. The second pillar is leverage. The banks do not trade with their own money. They trade with borrowed money. They use leverage of 30 to 1, sometimes 50 to 1. This means that for every dollar of their own capital, they control $50 of silver exposure. Leverage is wonderful when the trade goes your way. It multiplies your profits. But leverage is fatal when the trade goes against you. It multiplies your losses. Let me show you the math. If a bank is leveraged 30 to 1 and the price moves 3.3% against them, they lose 100% of their equity. They are wiped out. Silver moved 15% in the last week. That means any bank that was leveraged more than 7 to 1 on the short side has lost more than 100% of their capital. They are not just losing money, they are insolvent. This is the second pillar, leverage implosion. The third pillar is the reflexive buying. When a bank is losing money on a short position, they have to buy to close the position. This is called covering. But when they buy, the price goes up. When the price goes up, other shorts start losing money. They also have to buy. This creates a chain reaction, a cascade of forced buying that feeds on itself. This is not speculation. This is mechanics. The buying is not voluntary. It is mandatory. The risk models require it. The margin calls demand it. The clearinghouse enforces it. The shorts are being marched to the slaughter by their own algorithms. This is the third pillar, forced liquidation. Now combine all 3 pillars, physical scarcity plus leverage implosion plus forced liquidation. You get an unstoppable price movement. You get a market that moves 5% in an hour. You get $90 silver. But wait, why can't the banks just refuse to cover? Why can't they just hold their short positions and wait for the price to come back down? Because of the clearinghouse. The COMEX is guaranteed by a clearinghouse called CME clearing. Every day the clearinghouse calculates the value of every position. If a bank is losing money, they must post additional collateral by the next morning. This is called variation margin. If they cannot post the margin, they are in default. If they default, the clearinghouse seizes their position and liquidates it. The banks cannot hide. They cannot wait. They cannot hope. They must pay or they die. And paying means buying silver, which makes the price go higher. Which means they owe more tomorrow. This is why I say they lost control. The system they built to manage risk is now destroying them. The algorithms they wrote to protect them are now hunting them. The leverage they used to profit is now bankrupt them. There is a beautiful irony here. For years, the banks used leverage to suppress the price. They would sell massive amounts of paper silver at key moments to trigger stop losses and scare away buyers. They called this painting the tape. They were artists of manipulation. But now the canvas has turned against them. Every manipulation trick they used is being used against them. The stops they used to hunt are now hunting them. The leverage they used to profit is now destroying them. The paper they printed is now worthless. The predator has become the prey, and the prey has nowhere to run. The physical market is closed to them. The miners are not selling. The refiners are not delivering. The coin shops are empty. The only place to get silver is the futures market. And every purchase in the futures market pushes the price higher. This is a closed loop of destruction. It ends only when the last short has covered. It ends only when the last bank has surrendered. It ends only when the price has risen high enough to shake loose the physical metal from strong hands. That price is not 90. That price is not 100. Based on the math of the short position and the scarcity of the metal, that price might be $150. It might be $200. Nobody knows because we have never been here before. We are in blue sky, and in blue sky, anything is possible. The silver squeeze is not contained. It cannot be contained because silver is not an isolated market. It is connected to everything. And when silver moves 50% in a month, it sends shockwaves through the entire financial system. Let me show you the connections. First, the banking system. The major banks that are short silver are the same banks that make markets in bonds, currencies, and derivatives. They are the plumbing of the financial system. When they start bleeding money on silver, they do not have separate pockets for each market. The losses come out of their total capital. Their balance sheets shrink. Their ability to lend contracts. Their willingness to take risk evaporates. We are already seeing this. The repo market is seizing up. Interest rates are spiking overnight. Banks are hoarding cash because they do not know who is solvent and who is not. The trust that lubricates the financial system is evaporating, and it is evaporating because of silver. Second, the bond market. When the banks lose money, they sell assets to raise cash. The most liquid asset they own is government bonds, so they sell treasury bonds. This pushes bond prices down and yields up. Higher yields mean higher borrowing costs for the government. Higher borrowing costs mean bigger deficits. Bigger deficits mean more money printing. More money printing means higher silver prices. Do you see the loop? Silver goes up. Banks bleed. Banks sell bonds. Yields rise. Government prints money. Silver goes up more. This is not a linear relationship. It is exponential. It is a spiral. And we are in the early turns of that spiral. Third, the currency market. As the banks struggle, confidence in the dollar erodes. International investors start questioning the stability of the American financial system. They start moving money to safety. And what is safer than the dollar? Gold, silver, hard assets that cannot be printed. The dollar index has dropped 3% in the last week. That is a massive move for a currency. And it is directly correlated to the silver squeeze. The world is watching. The world is judging. And the world is voting with its capital. Fourth, the stock market. The leverage losses in silver are forcing banks to reduce risk everywhere. They are selling stocks to raise cash. They are unwinding positions in tech, in energy, in finance. The correlation between silver and the S&P 500 has gone negative. When silver goes up, stocks go down. This is not a coincidence. It is causation. The retail investor who does not own silver is watching his 401k decline. He does not understand why. He does not know about the clearinghouse. He does not know about the leverage. He just knows his portfolio is shrinking. This is the hidden cost of the squeeze. The losses are not contained to the banks. They are spreading to everyone who's exposed to the banks. Fifth, the geopolitical dimension. Silver is a strategic metal. It is essential for missiles, for satellites, for electronics. The countries that control silver control the future. Right now, the United States is watching its strategic reserves disappear into the hands of foreign buyers. China has been accumulating silver for years. They saw this coming. They are now sitting on a mountain of metal while the West scrambles. The Shanghai silver price is leading the New York price. This is unprecedented. It means the center of gravity has shifted east. If the United States tries to intervene, if they try to cap the silver price or ban exports, they risk a trade war. They risk retaliation from China. They risk losing access to the rare earths and semiconductors they desperately need. The silver squeeze has become a geopolitical chess match, and America is playing from behind. Sixth, the mining sector. The companies that dig silver out of the ground are being transformed. For years, they operated on thin margins. They were price takers. They had no power. Now they have all the power. The metal they produce is worth twice what it was worth a month ago. Their profits are exploding. Their stock prices are soaring. But something else is happening. The miners are not selling. They are stockpiling. They know the squeeze is not over. They know the price is going higher. So they are holding their production, waiting for better prices. This removes even more supply from the market. It tightens the noose around the shorts. Some miners are being approached for acquisition. The major mining companies want to buy reserves in the ground. They are offering premiums of 50%, 60%, even 100% above current stock prices. This is the M&A wave I predicted. It is happening now. Seventh, the retail awakening. The public is finally paying attention. Google searches for buy silver have gone vertical. Coin shops that have been empty for years are seeing lines around the block. The online dealers are sold out. The retail investor is trying to get in, but there's nowhere to buy. This is the final stage of a squeeze. When the public arrives, the demand overwhelms everything. The public has trillions of dollars in savings accounts earning nothing. If even 1% of that money moves into silver, the price doubles again. The contagion is complete. It started in the silver pit. It spread to the banks. It spread to the bonds. It spread to the currency. It spread to the stocks. It spread to the geopolitics. It spread to the mines. And now it is spreading to the public. They lost control of silver. And in losing control of silver, they are losing control of everything. The question everyone is asking is simple. Where does silver go from here? What is the target? When does it stop? The honest answer is that nobody knows. We are in uncharted territory. The price discovery mechanism is operating without historical precedent, but we can use mathematical frameworks to project possible targets, and we can use scenario analysis to prepare for different outcomes. Let me start with the Fibonacci extensions. When an asset breaks its all-time high, traders use Fibonacci ratios to project the next resistance levels. These ratios are based on natural mathematical relationships. They predict human behavior in the absence of other data. Silver broke through its previous all-time high of $50 several weeks ago. Using that level as our base, the Fibonacci extensions give us the following targets. The 1.618 extension sits at $81. We have already blown through that. The 2.0 extension sits at $100. This is the next major psychological barrier. The 2.618 extension sits at 131. This is where the math says the first major pause could occur. But Fibonacci is just one tool. Let me show you the fundamental valuation. In 1980, silver reached $50 per ounce. Adjusted for inflation, that would be approximately $190 in today's dollars. We are currently at $90. That means silver has not even reached its inflation-adjusted high from 45 years ago. If we simply mean revert to that level, we have another 100% upside from here. But wait, the fundamentals today are better than 1980. In 1980, there was no solar industry. There was no electric vehicle industry. There was no 5G infrastructure. The industrial demand for silver has multiplied by a factor of 10 since then. The supply has not kept up. If the fundamentals are 10 times better, should the price be 10 times higher? I'm not saying silver goes to $500, but I am saying that $100 is not crazy. $150 is not crazy. These are mathematically defensible targets based on the supply and demand dynamics. Now let me give you the scenarios for what happens next. Scenario 1, the controlled descent. In this scenario, the banks manage to slow the squeeze. They raise margins to 100%, they implement position limits. They coordinate with central banks to release strategic reserves. The price still rises, but it rises slowly. $100 by end of month. $120 by end of quarter. This is the best case for the system. It gives the shorts time to cover. It prevents systemic collapse. Probability, 25%. Scenario 2, the vertical melt-up. In this scenario, the interventions fail. The physical shortage overwhelms the paper games. The price gap's of $10 per day. We see $100 this week. We see $120 next week. The banks start failing. The clearinghouse invokes emergency powers. Trading is halted. But when trading resumes, the price is even higher because the shorts still have not covered. Probability, 40%. Scenario 3, the forced settlement. In this scenario, the exchange declares force majeure. They say that physical delivery is impossible. They settle all outstanding contracts in cash at the last traded price. The paper market closes. The physical market decouples completely. You see the spot price frozen at $90, while physical silver trades at $150 in the real world. Probability, 20%. Scenario 4, the government intervention. In this scenario, the Treasury and the Fed step in directly. They nationalize the silver market. They set a price ceiling. They confiscate private holdings. They declare silver a strategic reserve. This is the nuclear option. It would destroy confidence in American markets forever. But desperate governments do desperate things. Probability, 15%. Notice that none of these scenarios involve silver going back to $50. That world is gone. The shorts are too deep. The supply is too tight. The demand is too strong. The only question is how high we go and how fast we get there. Let me tell you what to watch for to determine which scenario is unfolding. Watch the spread between spot and physical. If coin dealers are charging $30 over spot, the physical market is decoupling. This points to scenario 2 or 3. Watch the COMEX inventory. If registered silver drops below 20 million ounces, the exchange is in crisis mode. This points to scenario 3. Watch the bank stocks. If JP Morgan and Citibank drop 20% in a week, the contagion is spreading. This points to scenario 2. Watch the political response. If senators start giving speeches about silver hoarders, the government intervention is coming. This points to scenario 4. Watch gold. If gold breaks $5,000, the entire precious metals complex is repricing. Silver could go to $150 in sympathy. The signals are everywhere. You just have to know where to look. I want to address the fear that many of you have. You're afraid that you missed it. You're afraid that $90 is the top. You're afraid to buy here. Let me give you perspective. In 1976, gold was at $100. People thought it was too high. It went to $850 by 1980. In 2010, Bitcoin was at $1. People thought they missed it. It went to $69,000 by 2021. The early stages of a paradigm shift always feel expensive. They are not. They are cheap compared to what is coming. $90 silver is not the end of the story. It is the first chapter. The story ends when the debt is restructured, when the currency is reset, when the monetary system is rebuilt. That story takes years to play out, and throughout that story, silver will be repriced. You have not missed it. You are early. Act accordingly. We have covered the mechanics. We have covered the contagion. We have covered the scenarios. Now we must cover the most important part. What do you actually do? The next 48 hours will be the most volatile of your financial life. The decisions you make or fail to make will echo for decades. This is not hyperbole. This is the reality of living through a monetary regime change. Let me give you the concrete action plan. Step 1. Do not sell your physical silver. I will say this again because it is the most important point. Do not sell. The temptation will be overwhelming. You will see your net worth jumping by thousands of dollars per day. You will think about taking profits. You will think about selling now and buying back lower. This is a trap. In a genuine supply crisis, there is no lower. The pullbacks are shallow and violent. They last hours, not days. If you sell at $90 thinking you will buy at $80, you might watch the price go to $110 while you sit in worthless cash. The banks need you to sell. They need your metal to cover their shorts. They will use every psychological trick to get you to part with your position. They will crash the paper price at 3 a.m. They will plant stories about a silver bubble. They will tell you that the smart money is selling. Ignore them. The smart money is the metal in your safe. Hold it. Step 2. Assess your counterparty risk. If you own paper silver, you are at risk. ETFs can be settled in cash. Futures contracts can be force closed. Allocated accounts can be rehypothecated. The only silver that is truly yours is the silver you physically possess. This week, take delivery. If you have an allocated account, call your dealer and demand your metal. If you own SLV or SIVR, consider selling and buying physical coins. If you own futures contracts, roll them to a delivery month and stand for delivery. The premium you pay for physical metal is not a cost. It is insurance. It is the price of certainty in an uncertain world. Step 3. Prepare for exchange disruptions. The COMEX may halt trading. The dealers may stop selling. The premiums may explode. You need to have already built your position before these events occur. If you are waiting for the perfect entry point, you may find that the door has closed. Do not try to time the bottom of a pullback. Get off zero. Buy something today, even if it is just a few ounces. Establish your position. Then add to it on dips. The first purchase is the hardest. Make it now. Step 4. Consider the miners. If you cannot find physical metal, the mining stocks are your second best option. These companies are leveraged to the silver price. If silver doubles, their profits might quadruple. The juniors and developers will see the biggest percentage gains. But be selective. Not all miners are created equal. Look for companies with low debt, high-grade deposits, and safe jurisdictions. Avoid companies with political risk in unstable countries. The silver is worthless if the government confiscates the mine. Step 5. Manage your emotions. The volatility will test you. There will be days when silver drops 10%. There will be moments when you doubt everything. This is normal. This is the price of being early. Zoom out. Look at the monthly chart, not the hourly chart. Remember why you bought. You bought because the debt is unpayable. You bought because the currency is dying. You bought because the industrial demand is exploding. None of those facts have changed. They are more true today than they were a month ago. Step 6. Ignore the noise. The financial media will try to scare you. They will call this a bubble. They will interview experts who say silver is overvalued. They will remind you of the crash in 2011. These are the same people who told you inflation was transitory. These are the same people who told you the banks were safe in 2008. They are not trying to help you. They are trying to protect the system. And the system needs you to sell. Turn off the television. Close the financial websites. Trust the math. Trust the metal. Now let me leave you with the bigger picture. What we are witnessing is not just a trade. It is not just a squeeze. It is the end of an era. For 50 years, the world has operated on a monetary system based on debt and leverage. That system required constant growth. It required constant confidence. It required constant manipulation of the price signals. That system is breaking. Silver is the canary in the coal mine. It is telling us that the manipulation has failed. It is telling us that the physical world still matters. It is telling us that you cannot print your way to prosperity forever. The institutions that ran the system are losing control. The Federal Reserve is losing control of interest rates. The Treasury is losing control of the deficit. The banks are losing control of the silver market. Control is slipping away on every front. This is terrifying if you are part of the old system, but it is liberating if you are prepared for the new one. The new system will be based on hard assets. It will be based on real production. It will be based on honest money. Silver is honest money. It has been money for 5,000 years. It will be money for the next 5,000 years. You are not just protecting your wealth. You're positioning yourself for the new world. You're exchanging dying paper for eternal metal. You are trading a claim on a bankrupt system for a piece of physical reality. This is the opportunity of a lifetime. Do not waste it. They lost control. They are never getting it back. The squeeze they cannot stop has only just begun. The price of $90 is the floor of the new paradigm. The ceiling is somewhere in the clouds. Hold the line. Add to your position. Prepare for volatility. And watch history unfold. The greatest wealth transfer of our generation is happening right now. Make sure you are on the right side of it.